Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
hmm
Wow, talk about a week that kept us on our toes. We saw some pretty dramatic swings in the market thanks to all the tariff talk,
Yeah.
and then some of those moves kind of reversing themselves.
Yeah.
It felt like stocks and bonds were trying to figure out which way was up.
Absolutely. The level of uncertainty, injected by these trade developments,
Hmm.
it's created a real tug of war in the markets.
Mm-hmm.
We've seen this reflected in the speed and the magnitude of the price swings. Makes it challenging for everyone, really. Individual investors, large institutions, hard to get a firm read.
And that's precisely what we're going to try to get a better handle on in this deep dive. We've pulled together a bunch of headlines from sources like MarketWatch and
A
Bloomberg
good idea.
to really dig into the immediate fallout and, well, the potential longer-term consequences of these trade wins. We're looking at stories like that MarketWatch piece. Battered big technology stocks like NVIDIA can be havens in disguise.
Interesting take.
Yeah, isn't it? Then we have Bloomberg reporting on BlackRock misses long-term flow expectations amid Asia outflows, alongside MarketWatch's rather serious headline. BlackRock's Larry Fink compares current climate of anxiety and uncertainty to 2008 financial crisis.
Wow. Okay. And on the direct trade front, we can't ignore MarketWatch's reporting in China fires back for what it says is the last time by lifting U.S. tariffs to 125%.
That sounds pretty final.
It does. And then Bloomberg detailing the impact on companies with Delta, Levi's, Walmart show tariff impact on corporate earnings outlook, and that concerning analysis in MarketWatch. GM's cost for cars made in Mexico or Canada rise by $4,300 per vehicle and dent profit. That's a big number.
It really is. And it's not just the direct corporate impact. We're also seeing how investors are reacting. MarketWatch has a piece titled, "Investors Are Shunning America." This wealth management giant says, actually, U.S. stocks are attractive.
Two different views there.
Exactly. Presents two very different perspectives. We also have the latest from the oil markets in Bloomberg's latest oil market news and analysis for April 11. And a look at the housing market with MarketWatch's mortgage applications jumped 20% as rates hit a 6-month low.
Okay.
Plus, the big question of how this all plays into trade war risks takes center stage as bank earnings season begins, according to the Wall Street Journal.
Right. Bank earnings are coming out.
And we can't forget Bloomberg's report that treasuries are trading like risky assets in warning to Trump, which is definitely not something you see every day.
Oh, very unusual.
Then there's the apparent resilience of undaunted retail investors bruised by S&P 500's big reversal, as reported by Bloomberg, and the contrasting view from MarketWatch that stock market extremes are the norm now. The key is to not get emotional.
Easier said than done sometimes.
Right. Alongside Peter Navarro's opinion in MarketWatch that Thursday's stock market downturn was no big deal. And finally, some food for thought in the Wall Street Journal with 4 questions you should ask to combat the market chaos.
So a really broad spectrum of news reflects a market grappling with significant policy shifts.
Exactly.
Our goal in this deep dive, then, is to synthesize these diverse reports for you, our listener. We want to extract the key insights, understand the different expert viewpoints, and really make sense of what this all could mean for your financial outlook without getting lost in the noise.
Right. Trying to connect the dots between all these seemingly separate headlines.
That's the challenge.
Absolutely. Let's start with the most immediate trigger, China's tariff response. According to that MarketWatch article, China fires back. They've upped their tariffs on U.S. goods to a hefty 125%.
Wow.
And this took effect yesterday, April 12th. What really jumped out was their strong statement saying this is the final time.
The final time.
Yeah, and their assertion that any further tariff hikes from the U.S. would be, quote, a joke. That sounds like they're drawing a very firm line in the sand.
It does indeed. That's not just tit for tat anymore. It suggests a fundamental shift in their approach, maybe. Well, the article implies they believe they've reached a point where further U.S. tariffs would have minimal additional economic impact on them. So they'd see it as purely symbolic, maybe ineffective.
Makes you wonder where the off-ramp is in all this.
Exactly. Where does it go from here?
And digging a little deeper into the numbers, that same MarketWatch piece, Stock Market Extremes, mentioned that the total tariff burden on China from the U.S. now sits at 145%.
145. How does that break down?
Well, it's the 125% retaliatory tariff we just talked about, plus the existing 20% related to fentanyl. So we're talking about a really substantial barrier to trade now.
Precisely. These aren't minor tweaks. They represent a significant increase in the cost of goods flowing between the world's two biggest economies.
Right.
And that has implications, not just for businesses directly involved, but also for consumers. Potentially higher prices. It's drag on overall economic activity.
And then you have Peter Navarro, as reported by MarketWatch, in Thursday's stock market downturn was no big deal, essentially saying all the market jitters are overblown.
No big deal.
Yeah, pure spin, he called it. He framed Thursday's dip as just a normal pullback after Wednesday's big jump,
Okay.
and emphasized that trade negotiations are ongoing. Painted a picture of the U.S. being in a strong position. Feels like a very different interpretation compared to the market reactions we saw.
It is a stark contrast. I mean, sure, markets often see corrections after big gains, but dismissing the reaction as pure spin, it might underestimate the genuine anxieties businesses and investors have
Yeah.
about the potential economic fallout from this escalating trade war. His optimism, while maybe warranted from his perspective, doesn't necessarily soothe the immediate uncertainty companies face when trying to plan.
Right, that divergence between the official line and the market's behavior is striking.
It really is.
And boy, did the market have some behavior this week.
Yeah.
As MarketWatch highlighted in Stock Market Extremes, we saw the S&P 500 rocket up by 9.5% on Wednesday.
Biggest single-day gain since 2008.
Right. Only to then take a sharp nosedive on Thursday. It's like the market's internal compass is just spinning wildly.
Yeah.
That Wall Street Journal article, 4 questions, used a great analogy, like traffic lights going haywire to describe the chaos.
That analogy really captures the feeling, doesn't it? These rapid reversals. They show a high degree of sensitivity to any trade news, obviously, but also like a fundamental uncertainty about the economy's strength underneath it all.
Yeah. Investors are clearly struggling to find, a sense of direction, stability.
Exactly.
And it wasn't just stocks feeling the tremors. Bloomberg's report, Treasuries are trading like risky assets, pointed out something really unusual.
Yeah, what was that?
Treasury yields were surging and the dollar was plunging right alongside stocks.
At the same time.
Yeah.
That is odd.
Lawrence Summers even compared it to emerging market debt. Now, for listeners, U.S. Treasuries are usually seen as the ultimate safe haven, right?
Exactly. The traditional relationship is stock market goes down, investors run to safety in treasuries, that pushes bond prices up, yields down. So seeing yields rise, meaning bond prices are falling during a stock sell-off, that suggests maybe an erosion of that safe haven status, or at least a rethinking of the risks with U.S. assets right now.
What could cause that?
Well, maybe concerns about the long-term impact of the trade war on the U.S. economy itself. Potential inflation down the road could be a few factors contributing to this unusual behavior.
Adding to that, Bloomberg's stock market today noted the dollar index slumped to a 6-month low.
6-month low, okay.
And the euro hit its highest point in 3 years. Strategists at ING even used the strong phrase, dollar confidence crisis.
Confidence crisis. Wow. That's more than just a minor fluctuation.
Sounds like it.
It does, a weaker dollar. Well, it makes U.S. exports cheaper, but it also raises import costs, which could feed inflation. The fact that strategists are using terms like that suggests a deeper concern, maybe about the dollar's standing, with all this economic and political uncertainty swirling around.
Interestingly, though, not all traditional safe havens were acting strangely. Bloomberg reported gold prices shot up,
Gold!
reached a record above $3,200 an ounce, which is exactly the kind of reaction you'd expect, right? Investors looking for safety in turbulent times.
That's right. Gold's role as a hedge against uncertainty, a store of value. That seems pretty consistent. When other assets get volatile, investors often turn to gold. Drives the price higher.
Okay, so we've seen the tariffs spark market chaos. Let's look at how this is hitting actual businesses. Bloomberg's article, Delta, Levi's, Walmart Show Tariff Impact, paints a picture of widespread uncertainty. CEOs really struggling to predict what these tariffs will mean for their bottom lines.
This is where the rubber meets the road sort of thing, the unpredictability. It's making it incredibly difficult for companies to plan.
How so?
Well, we're seeing examples like Delta Airlines pulling their full-year financial guidance, CarMax pushing back timelines for financial goals, Walmart widening their income growth estimate.
All citing tariffs.
All directly citing the uncertainty from tariffs. And that lack of clarity, it can lead to delayed investments, maybe hiring freezes, which has broader economic consequences, right?
Yeah, makes sense. And it seems the frustration level is pretty high. the CEO of JD Sports Fashion, reportedly told analysts, don't even bother asking about tariffs on the earnings call.
Wow. Speaks volumes, doesn't it?
Yeah.
About the anxiety and just the difficulty in even quantifying the impact.
And then you have Levi Strauss, highlighted in that Bloomberg piece, a prime example of how tariff uncertainty injects volatility into a stock price, even after they report decent earnings initially.
The Levi's case is a great illustration. The market's looking beyond just past performance to future risks.
Right.
So even if recent earnings were okay, the looming uncertainty about tariffs, future costs, sales, it makes investors nervous. It highlights how forward-looking the market is and how sensitive it is to potential disruptions.
MarketWatch's analysis of GM's cost was also pretty sobering. UBS analysts projecting a significant, $4,300 increase in the cost of each vehicle GM makes in Mexico or Canada and sells here.
$4,300 per vehicle, yeah. And for cars from Korea or China, it jumps to $6,250.
Whoa, that's huge. They even suggest GM might have to withdraw its financial guidance for 2025 because of this.
It is a substantial increase, and while UBS thinks GM will try to pass some costs to consumers,
Higher prices.
right, they probably won't be able to pass on the whole amount, so that inevitably squeezes profit margins.
Yeah.
And the potential withdrawal of their 2025 guidance just underscores the magnitude of the uncertainty. How difficult it is to make long-term projections now raises questions about competitiveness, too.
So with all this potential disruption to corporate earnings, how are investors behaving? Bloomberg's report on undaunted retail investors. It points to a really interesting trend.
What's that?
Individual investors seem to be sticking to their guns, continuing to buy the dip whenever the market falters.
Still buying the dip.
Apparently.
Yeah.
Poured $4 billion into the market just on Thursday. Net bought $11 billion since April 2nd. Even outperformed the broader market during that time, according to the report. They seem remarkably confident.
That's a fascinating insight into current investor psychology. Suggests maybe many retail investors, particularly those who got active during the pandemic, have been conditioned, downturns buying opportunities.
Wednesday's rally probably helped that idea.
Probably reinforced it, yeah. Though the article also notes these recent buys haven't offset earlier losses this year. So portfolios might still be underwater.
Okay, but on the flip side, MarketWatch's article, Investors Are Shunning America, highlighted that overall bearish sentiment among individual investors, like the AAII survey, is actually quite high.
So some are buying, but the overall mood is bearish.
Seems like it. And historically, high bearishness can sometimes be a signal the market might be due for a rebound, a contrarian indicator.
That's a crucial point. While a segment of retail is actively buying, the broader sentiment suggests significant underlying concern. The contrarian view is, well, when everyone's pessimistic, maybe things can only get better, but...
What?
But contrarian indicators aren't foolproof, right?
No.
You have to look at them in context with other economic data.
True. And adding another layer, that same MarketWatch article reported UBS Global Wealth Management has actually upgraded their outlook on U.S. equities to attractive.
Upgraded? Why?
Their reasoning is interesting. They think the pause on some tariffs reduced the worst downside risks. They think we might see some positive trade news develop. And historically, high volatility periods are often followed by positive returns.
Okay, so they're seeing opportunity in the volatility.
Yeah, and they even brought up the concept of a Trump put.
Ah, the idea the administration might step in to support the market if things get too rough.
Exactly. Suggesting the administration might take steps, policy or rhetoric, to prevent a major slide.
That's a significant counter-argument to all the caution we're hearing. UBS GWM is basically saying the market might be overreacting. They believe the administration has an incentive to prevent a crash, providing some underlying support. The history bit adds weight, too.
Interesting. Let's pivot now to BlackRock, real bellwether in investment management. MarketWatch's headline, BlackRock's Larry Fink compares current climate of anxiety and uncertainty to 2008 financial crisis, certainly grabbed my attention.
2008, that's serious.
Fink is saying his client conversations are dominated by uncertainty and anxiety about these market swings, drawing parallels to 2008, the pandemic, the 2022 inflation surge.
Wow. Coming from the head of the world's largest asset manager, that comparison highlights the magnitude of the perceived risks right now.
Yeah.
He's pointing to a mix of things: geopolitics, trade wars, inflation, volatility creating significant unease, like periods of major economic stress. Suggests these aren't just short-term jitters, but maybe more fundamental concerns?
And as Bloomberg reported in BlackRock Misses Long-Term Flow Expectations, They did see lower than expected long-term investment flows in Q1, money flowing out of institutional index funds in the Asia-Pacific region.
So lower flows.
But their total assets under management remained relatively stable. What can we infer from that?
Well, in the missed flow expectations, especially outflows from institutional index funds, it could suggest some larger, sophisticated investors are getting more cautious, reallocating assets maybe due to global uncertainty, including the trade war.
And the Asia outflows.
Might reflect specific concerns there. But stable overall AUM means they're still attracting and retaining a lot of investment. Maybe market appreciation in other areas offsets some outflows.
Interestingly, despite Fink's cautious tone, MarketWatch also ran a story. Battered big technology stocks like NVIDIA can be havens in disguise, featuring a fund manager, Raghavendran Sivaraman.
A haven in tech after the recent sell-offs.
Yeah, he's making the case that major tech companies like NVIDIA, despite recent struggles, could actually become safe havens because of strong financials, growth potential in AI.
Okay.
He even suggests they might be positioned to acquire smaller tech firms during a downturn.
That's another interesting perspective. He's arguing these dominant tech players have the balance sheet strength, the growth prospects, and key future trends enough to weather storms and maybe emerge stronger.
Using their cash to buy competitors.
Could be. It's a view focused on long-term secular trends, not just short-term market noise.
Okay, shifting focus beyond equities. The oil market is also feeling the effects. Bloomberg's latest oil market news reported oil prices are on track for a weekly decline,
Why?
primarily due to the escalating trade war and growing worries about a slowdown in global economic growth.
Makes sense.
The U.S. Energy Information Administration even lowered its forecast for crude oil demand.
The logic is pretty direct there, isn't it? Trade war dampens global economic activity, disrupts supply chains, raises costs, hurts confidence.
Leads to lower growth.
Yeah, which usually means reduced demand for energy, like oil, puts downward pressure on prices. The EIA forecast just reflects that expected slowdown.
On a slightly brighter note, maybe for some, MarketWatch's mortgage applications jumped 20%. Reported mortgage rates fell, lowest level in 6 months.
Lower rates.
Yeah.
Leading to a surge in applications?
Yep, big jump. But the Mortgage Bankers Association did issue a cautionary note,
Oh.
saying volatility in the mortgage market is likely to continue because of the broader economic uncertainty from tariffs.
So good news on rates for now, but maybe temporary.
Could be.
The drop is certainly welcome for homebuyers and refinancers, but the MBA warning just highlights how interconnected everything is.
Yeah.
Renewed trade tensions hurting the economy could easily reverse that rate trend, cool the housing market again.
Finally, we're heading into bank earnings season. The Wall Street Journal's article, Trade War Risks Take Center Stage, suggests investors will be paying much closer attention to the outlook from banks like JP Morgan, Wells Fargo, Morgan Stanley.
Less focus on past results, more on the future.
Exactly. The uncertainty around the trade war is the key concern. Jamie Dimon even mentioned increased recession risks earlier.
Right. Banks are often seen as a barometer for the whole economy. They don't pay tariffs directly, but they're heavily exposed to the fallout.
Like credit losses.
Yeah, increased credit losses if businesses and consumers struggle, or a slowdown in lending if growth falters. Investors will be scrutinizing earnings calls for how execs are assessing these risks.
And as that WSJ article pointed out, the Q1 numbers might not fully reflect the latest tariff impact yet.
Due to accounting lags, yeah.
So the commentary from management will be absolutely crucial. Chris Stanley from Moody's Analytics raised the key question: how long will these tariffs last? Because that answer really impacts banks' estimates of potential credit losses.
Exactly. The forward-looking guidance, that'll be critical for gauging their concern level and how they're positioning themselves for this uncertain landscape shaped by the trade dispute. Listening for signals about loan loss reserves, economic forecasts.
So as we wrap up this deep dive, it's clear we've seen a week packed with significant developments and a lot of conflicting signals.
Definitely.
We have China escalating tariffs leading to immediate market volatility, big swings in stocks, weird behavior in bonds and currencies. We're seeing a real divergence of opinion on U.S. stocks right now. Is it attractive? Are people shunning it?
Oh, seem to be happening.
The impact on corporate earnings is a major question mark. Retail investors seem determined to buy the dips.
While institutions sound more cautious.
Right. Major financial institutions expressing caution.
Yeah.
Oil market weakening, mortgage rates down, but maybe volatile.
Yeah.
and bank earnings coming up with the trade war worries front and center.
Yes, it's a very complex, very fluid situation. The key takeaway, I think, is that this escalating trade war is creating significant uncertainty across all sectors.
Yeah.
There are compelling arguments on both sides for optimism and for caution. Really underscores the need for investors to, stay informed and think critically.
Absolutely. And as Jason Zweig wisely advised in that Wall Street Journal 4 Questions piece, now is definitely the time to step back. Really consider your strategy.
They ask this tough questions.
Yeah. What do I own and why? Has anything fundamentally changed? If I didn't own this asset, would I buy it today? It's about thoughtful consideration, not just reacting emotionally to the daily swings.
Indeed. Having that well-defined long-term plan, understanding your own risk tolerance, it's more important than ever in times like these.
Well, that brings us to the end of our deep dives into this week's major financial headlines. Hopefully, this has provided you, our listener, with a clearer picture of the key dynamics at play, helped you navigate this complex landscape.
We hope so too. It's a constantly evolving story, and we'll definitely keep following these developments closely.
We'll see you all Monday morning with new headlines from major financial magazines.